Okay, well, good afternoon. Welcome, everyone. Thank you for joining us for this Keynote Economics panel. We do appreciate your attendance and your attention for the next hour. But don't worry too much that we'll leave you languishing there in the dark, because we aim to make this a free-flowing, dynamic, and an interactive discussion. And we'll ensure that there's plenty of time towards the end for discussions. So bear in mind, I think both of our speakers here will have quite a lot to say that's interesting and worth picking up on and discussing further. So keep your questions as we go along, and you will get your chance to pick the brains of our two experts here in their respective fields. I'm Courtney Fingar. I'm editor of FDI magazine from the Financial Times Group in London, and I'll, of course, be your moderator. I'm joined here with a leading European economist and also a top-ranked property investor and real estate expert. So I think we can cover both ends here, with the economic situation obviously providing the backdrop for the real estate market. So what we'll do in terms of proceeding is first we'll ask Holger Schmieding, who's there on the end. He's chief economist at Berenberg Bank in London. He'll give us his assessment of the economic outlook, what are the prospects for the future, and just his general take on the macro situation. After that, we'll turn to Pierre Vaquier, who's CEO of AXA Real Estate in France. And then he'll tell us what this means for the real estate market and give us the implications of this macro situation. And then, of course, we'll continue on with the discussion between the two of them, and then engage yourselves. So, Dr. Schmieding, you warned me before we took the stage that you were going to be an optimist here, and I don't think anybody will be sad to hear an optimistic view, even though that means our dismal scientists might not be so dismal. So tell us, please, your outlook and what are your grounds for this optimism?
Thank you. Yes, indeed, ladies and gentlemen, I will give you a somewhat optimistic assessment of the economic outlook for major regions of the world. In my view, we are in a rock and roll recovery. It is a recovery. It is rocky occasionally. This is not a smooth path. We have a lot of obstacles, but the recovery will very likely keep on rolling in the major regions of the world. Thus, rock and roll recovery. The key driver of this is money. When you talk about economics, never forget one thing. Money is very, very powerful. 2 years ago, to this day actually, global equity markets hit bottom and turned around fairly sharply thereafter. Why? A very simple reason. Because the US Fed, the Central Bank of America, had spoken. In early March 2009, the US Central Bank told the world, we, the providers of dollars, we, the one institution in the world that, if need be, could print as many dollars as are needed. We will make sure that the financial system will not collapse. And immediately thereafter, the panic in world financial markets came to an end. Remember, what we had seen after Lehman Brothers was not a normal recession. It was not the normal correction of excesses in real estate markets. It was something very different. It was a financial panic caused by the mistake of the century, namely to let a key ingredient of the global money and wholesale financial markets, Lehman Brothers, simply go under in a chaotic bankruptcy rather than winding it down orderly. So that panic triggered a dramatic recession in the world economy, because when banks no longer looked safe, households and companies across the Western world thought, ouch, maybe our bank isn't going to be there after the next weekend. So what do? We should be on the safe side. We need some extra liquidity. And if most of the world wants to have extra liquidity at the same time, how does it do that? It cuts back investment plans. You don't need to invest now. You can invest a little later. It cuts back on car purchases. The old car is still driving, isn't it? So we had, after Lehman Brothers, the worst collapse in business investment and car sales in the Western world that I've ever seen, in brackets, outside war times. That was the very deep recession caused by a policy mistake largely. But then, again, when the US Fed finally said, we will do everything it takes, in brackets, we buy government bonds as many as we need to buy, and we give out dollars in exchange for the government bonds, markets turned around. And we are still in this process. If we look at monetary policy in the Western world, we see that it is the most expansionary that we have ever had, for all I know, in human history. Interest rates are extremely low by central banks. Inflation is still fairly low, but it's no longer absolutely low. So you could say real interest rates are really very, very low. And monetary policy is very powerful. It is gradually overcoming the obstacles that do still exist in a somewhat impaired financial sector. But as the financial sector is in general in the Western world gradually healing, this monetary stimulus is actually more and more getting through to households and consumers instead of just getting stuck in the financial industry. Which means the natural course of events for the Western world, where monetary policy is extremely aggressive, is a very strong economic upswing that would likely get even stronger over time. More precisely, I don't think it will get stronger than it was last year, but I want to emphasize that it does take some obstacles in the way to prevent the economic upswing from getting stronger, because monetary policy is working more efficiently with the financial system less impaired. So we actually do need some fiscal tightening, which we are getting in parts of the Western world. We do need some obstacles, such as a modest increase in oil prices. We will need very soon some actual increases in interest rates to move them from ultra low to just low. We will need such things, such obstacles, to actually prevent the Western economies from gaining even more traction than they have gained over the course of last year. So in general, I have a fairly positive outlook for the Western world. We are seeing obstacles to growth. We are seeing some fiscal tightening. We are having to bear the burden of higher oil prices now. But with monetary policy being so aggressive, it will more or less, on a somewhat rocky path, it's never going to be smooth, on a somewhat rocky path, overcome most of these obstacles and keep the recovery rolling for a while. Let me briefly address a few other points that are relevant in this. The first one is when policymakers are really determined to get something done, they can do it. So if monetary policy wants to engineer an economic recovery, it can do it. But it also means if European policymakers really want to keep the euro together, they have no problem with that. They can do it. Germany's Chancellor Merkel has said that she would do everything that needs to be done to keep the euro together. I would just take her at her word for it. So far, Germany and France and others have done all it takes to not overcome the euro crisis completely, but to keep it under control. And let me say a word of praise here for Europe. When the US had a financial crisis in 2008, it reacted to it in such a way that by late 2008, the world was in its worst recession in 60 years. When Europe faced a grave financial crisis in the May of last year, it constructed a safety net, which actually meant that in that very year, last year, 2010, major parts of Europe, including Germany, had their best economic year in a long time. So far, the European response to the euro debt crisis, which is a very severe crisis, has by and large worked, not perfectly. We need to add to the defenses in a few weeks' time, but it has prevented any of the kind of calamity which befell the US and the world when in 2008 the US had faced a crisis. So my point is here, there is a risk, and the risk is serious from the European debt crisis. But so far, politicians have managed it by and large fairly well. And a second related point. What I'm actually seeing in Europe is not just a crisis. I am seeing fundamental change. Even the fact that France last year got a modest pension reform speaks volumes. Previous French governments had not managed to get that through because the European debt crisis has put in motion a wave of structural reforms in major parts of Europe, not just fiscal cuts, which are necessary and are being done at the Euro periphery and beyond, but also structural reforms, labor market reforms, pension reforms, a few other reforms, which are, interestingly, exactly the kind of reforms which Germany introduced in the years after 2003 and which helped to turn Germany around from the then sick man of Europe to, well, the star performer among the major economies of Europe now. We do have a chance that if the Euro periphery now goes down the route of reforms, as they have started to do last year, they will, say, a couple of years from now, emerge much stronger than before, just as Germany has emerged stronger rather than weaker from its own period of austerity and reforms. So in general, I'm optimistic for the Western economies, incidentally also for many, not all, of the emerging markets economies. I do see positive change in Europe. I do see a backdrop which for real estate markets is basically fairly positive. But of course, I have to warn you, there are risks around if we make another policy mistake, like the disorderly Lehman bankruptcy. If we let, for some reason, the European debt crisis spiral out of control, or if for some reason we get a major crisis in the really big oil producers around Saudi Arabia and the Arab Emirates, then of course my positive outlook for the world economy would, put it that way, be interrupted for half a year or up to a year. So there are risks around, but the general outlook is not bad. Thank you.
Thank you for that, and that is quite an optimistic backdrop. Does this extend to the real estate market?
Yeah, after such a bullish view, as a practitioner, I will be probably more moderate, I will say. It's true that, and I believe strongly in this economic scenario of recovery, that real estate will benefit from this situation because real estate is practically correlated to the economy. Also, we will obviously get the benefit. Nevertheless, there are other elements to take into account. The first element to look at are the attitude of investors. And investors are still nervous. There is still a lot of risk aversion, and this is not something which has started with the financial crisis. This is something which has been in place for the last, let's say, 12 or 15 years. Real estate was an attractive asset class, let's say 4 or 5 years ago, because people were considering as a diversification element and also as a way to de-risk their exposure by sometimes disposing of equity position to invest in properties. But this attitude of investor is still very strong about the risk aversion. It's increased by the fact that regulation is coming to play. In some businesses like insurance, for example, you have Solvency II regulation being applied, and those regulations are very new, are usually based on quantitative models, which not necessarily apply very well to an asset class such as real estate. And those elements will impact investors. When you look, in fact, at Solvency II, the results of the models are not particularly negative for real estate. The asset class is, in fact, fairly treated. Nevertheless, it's going to create a lot of complexity for the investors in the management of the real estate exposure. It might create also some kind of herd mentality, because the models will show the direction of what investors have to do. And as we know very well as investors, sometimes you have to be a little bit contrarian in your attitude. And those type of regulation will not help for this. The second element to keep in mind is the economy. We have just heard that the economy is going to recover and do very well. Nevertheless, we still have to manage a deleveraging of a lot of actors. The deleveraging has been transferred a lot from the private sector to the public sector, but still we have governments which have massive debt problems. And as we know, at the end of the day, those situations will have to be resolved by either higher taxes and lower consumptions. So this will have an impact in our business. I will come back to this in a few minutes, but in particular on the retail sector, we cannot expect a very, very rosy picture in the coming years. On the corporate sector, the situation has improved substantially, and what has come out of the crisis is that the corporate actors, industry, services, have reacted very well to the situation. Nevertheless, you still have one major component of the corporate sector which is very weak, which is the banking sector. A lot of banks, let's be very honest, have not recognized yet in their books the market value of assets. You have some major banking sectors or countries where the regulator is even helping them to smooth the situation. I have, for example, in mind the famous valuation system in Germany for properties. And as a consequence, it will mean that if you smooth a problem, it will take more time to resolve it. And as a consequence, it means that the debt will be more expensive than it was before. I don't believe in a lack of liquidity in the real estate. You know, new actors eventually, like long-term investors, will come to lend money to real estate, but they will do it with higher margins. And this will have an impact in real estate on all type of risk, and in particular on the most riskier part, and in particular as well for the players which are non-institutional. The service sector has come through the recession in a reasonably good condition, I just said. So as a consequence, we are very bullish on the office sector, considering that this is the asset class that should outperform on the short terms all the real estate sector. In particular, for the prime locations and for the good properties. So we'll, as an investor, we'll stay away from peripheries and invest in the major financial centers or economic centers around the world. And as this sector is very cyclical, we can expect, in fact, very fast recovery phases and quite profitable investment, in particular in developments. On the retail side, we are more reserved. The consumer, at the end of the day, will be affected by this over-leveraging situation and the increase of taxes. So this asset class, which has been the darling of investors for the last, let's say, 20 years, 15 to 20 years, and has performed systematically very well, will be affected and will become more polarized. It doesn't mean that we are completely negative on the assets. It just means we think that we should be very selective on this asset class, and some of the secondary assets might be deeply affected by the situation. On the logistics, as you know, this is a sector which has suffered, first of all, of high level of obsolescence, but also of major drop in capital values. On this, we consider that the global trade improvements will have a very positive impact on logistics, and that if the assets are correctly selected, this asset class will be very attractive. In terms of countries, if we look at the three big regions of the world, we are obviously very positive on the BRICS due to the growth situation we are finding in most of those markets. In Europe, we are selectively positive on most of the markets, with some exceptions. Clearly, there are markets which are structurally affected on the long term. Portugal, Ireland, Greece are countries for us where we have, for the time being, imposed investment bans in our portfolio. But we consider that this is an area where stock selection might be very attractive. And as we are believers as well on the fact that the euro will be maintained as a strong currency. We think that with the right pricing, some markets, such as Spain, for example, might become interesting in the coming future if the prices are prices of opportunistic acquisition. In terms of allocation in the different countries, we have a strong preference for excellent location and major centers. So we will stay away not only from the peripheries of major cities, but also from secondary markets. In the currency, if you are an actor in Europe, currently the Swiss franc and the Swedish krona are safe havens. The risk of certain countries leaving the euro is, we believe, nevertheless very small. In Central Europe, we are positive on a selective manner. In particular, countries like Poland, we are obviously more reserved on countries which have still a lot to do to manage the recession and their own financial situation.
Thank you for that. A few points that we can probably flesh out from both of your talks. But while we're speaking about geographies, as you did towards the end of your talk, I thought I would ask you, Dr. Schmieding, how even will the recovery be in terms of the various markets across Europe and globally? Because we can think about it in terms of the big global picture, and we might be seeing an upward curve, but how uneven will it be, and where are the danger spots? We could probably guess, but you can tell us a few.
Yes, of course. The economic recovery is not very even. It is, as usual, somewhat uneven instead. First of all, we have the big region of the emerging markets, which did not have all that much of a recession, or where, as in China, upon the onset of recession, authorities reacted immediately and massively to the threat. In these markets, we are likely to see a noticeable cooling of overall economic growth as the central banks gently but still take the foot off the accelerator and in some cases step a little bit on the brakes because of inflation, largely food price inflation concerns in these countries. So emerging markets, by and large, good prospects, but slower GDP growth than we had in recent years. Also, as they had assumed sort of a safe haven status when the US and Europe looked so bad a year or two ago, now they are likely to just be less popular, not because the long-term story has changed, but because the relatives of developed world recovering and emerging markets now stepping gently on the brake, the relatives now look a bit less favorable for emerging markets. So that's the one big block of the world. Then we have the next big block as part of the Western world, the US, which is in a way a country and almost a continent on its own. It does need serious fiscal tightening, but it has decided to postpone that to next year and thereafter, which actually is good for the world, because if everybody would be doing serious fiscal tightening at the same time, parts of Europe and the US, it would be a significant hit to global demand. But now that we have Europe outside Germany doing its fiscal tightening now, the US next year onwards, in brackets, and Germany did it 3-4 years ago, we actually have a nice succession of fiscal steps. The US this year looks set to have growth of around 3%. Next year it may cool a little bit, but not much, as the US Fed seems to be determined to offset any potential fiscal hit by keeping rates low a little longer than otherwise would be the case. So US looks okay. For Europe, of course, we have the well-known dichotomy between the core and the periphery, but in that we should be looking very carefully country by country. Germany did so well last year, it's still going to do well this year and next, but it will no longer accelerate beyond the very strong pace. It is a settled story. Germany is doing well. We will more likely see interesting news out of part of the periphery and out of Britain, which are following the earlier German example of doing fiscal tightening and growth-promoting structural reforms. My guess is that in much of the periphery, we will have still a bad start into 2011, but that in parts of the periphery and in Britain, we will have a significantly better ending to the year. My turnaround candidates for Europe later this year are Ireland and Britain, who will likely overcome the worst impact of their fiscal tightening before the year is out. So even on the European periphery or in fiscally challenged Britain, the outlook is not all negative.
Thank you. And you both suggest that any kind of collapse of the euro is very unlikely, but does just the specter of that impact investor sentiment? This might be something that you could speak to, Mr. Vaquier.
Yeah, you know, obviously at fall, when in November and December, when you started to have the situation unraveling, you had people considering that it might happen. But you know, I think people have drawn the lessons of what happened with Lehman. If the euro was at risk, to my opinion, it will not be a European situation. It will be a worldwide situation, and the world will have to react. So it's like, you know, it's too big to fail. I think the euro will resist. Obviously, you know, a lot of measures have been implemented as well. The governments have reacted to the situation with a lot of discipline. So I think the risk is, you know, is more or less not resolved, but the risk is getting away. It doesn't mean that some countries will not have to restructure their debt, you know, which is another issue. Some people have obtained delays to do it, but down the road, some countries might have to restructure their debt heavily, depending on how drastic their policies are.
We haven't really spoken yet about the Middle East, but obviously looking slightly beyond Europe, and if we want to talk about perceptions of risk, I'm wondering about the turmoil across Middle East and North Africa. And does that color perceptions of risk on the economic front and the investment front about emerging markets? And I guess how much, how worried are you about that? You'd referred to a potential oil crisis, and that kind of looms there as a knock-on effect. And then following on from that, in terms of investor sentiment, looking at emerging markets, how worried are they about a political situation? Maybe if you could answer first.
First of all, turmoil in emerging markets is a serious risk for this year for basically one reason. We have a significant rise in food prices in the world. Mm-hmm. For us, we typically spend about 5–6% of our income on actually food, the raw materials that go into food. So it isn't much. In poor countries, people may spend up to half their income on food. In emerging markets, it may still be 20–25% of their income on food. So in these countries, high food prices are potential political dynamite, and that might well apply beyond the Arab world. So that is a serious risk to watch the political situation in emerging markets. Having said that, many emerging markets now seem to be politically well managed to be able to contain the risk. Quite a few emerging markets, as major producers of food or other raw materials, are in a position to fully offset the shock from high food prices. What we, of course, have to watch for the world economy, for the Western world, food isn't that important. Oil is very important. What we have to watch, it's just a risk, is whether there could be a Libyan-style protracted civil war or similar unrest in major oil producers. Libya produces about 2% of the daily world output, which is something Saudi Arabia can and is now doing, simply offset by ramping up its own production. But if countries such as Saudi Arabia, the Arab Gulf Emirates, potentially Iran, if these really, really oil-rich countries were to have not an Egyptian-style change in government, a military coup, which would mean everything keeps working, it's just there are different leaders, if they were to have a Libyan-style protracted period of basically civil war, then the resulting spike in oil prices would be a very serious problem to the world. It is a risk, but there are always risks out there. I would not say that on balance we currently face more risks in the world economy than we did, say, half a year ago, when loads of people were fretting about a potential US double dip, which never emerged, or then, say, a year ago, when loads of people were believing that the euro would no longer be around by this time. So risks are there. This is a serious one, especially for emerging markets, but I still think it is more likely to not materialize than to really materialize badly.
So we haven't been able to dent your optimism yet. What does all this mean for the property market, though, and the way investors look at the global real estate map?
It just creates tensions. This was my first comment. The risk aversion element of the investors. People are very nervous. At the end of last year, they were concentrated on the euro situation, and suddenly something else happened, and everybody knew that the risk will exist. But I don't think anybody had predicted that the problem will happen in 2011. So, you move from a quarter to another with another major big element. The other solution that some people are proposing, which have to have great models to predict everything. I mentioned the Solvency II model. It's based on quantitative analysis of risk. The geopolitical situation demonstrates that in our businesses you have elements which are also judgmental elements, and I think people should not lose that perspective. A business should be balanced between sometimes some qualitative analysis, but also some judgment on what's happening. On the property market itself, very few investors have invested money in the region at risk. Also, it doesn't have a big impact. It might, in fact, accelerate the flow of capital in some other markets. We might have, in particular in Europe, some Middle East investors increasing their allocation to property. Also, it might have, short-term impact, but nothing major. If the difficult scenario will develop, which is Saudi Arabia being at risk, unfortunately, the economy will be impacted, and we could find ourselves in what I think is called stagflation, which is very low growth and inflation, which, if for the one of you who were working in the 70s, you probably remember that it's not fun for a lot of asset classes. Property has a little bit of advantage because in most of the market it's inflation indexed. Also, on that part, it's a little bit protected, but for the other elements, property will be affected as well.
And on the subject, continuing with emerging markets, you mentioned that you're quite bullish on the BRICS, and lots of people are. But are you looking beyond that to some of the other acronyms, the CIVETs and the EAGLES and all the rest? How do you look at maybe the next tier of the big emerging economies in terms of their prospects for real estate investment?
The real estate asset class is fundamentally correlated to the growth. So if you believe that a country is going to have a high growth, investing in property is one way to benefit from it. The difficulty is the execution. Those countries are emerging, so it means that executing transaction is not that easy. Transparency, liquidity, taxation, you have a lot of questions there. So we are very active in those markets, and we think that the way to be active is to be active in a short-term exposure, not in long-term exposure. So usually it's with developments or with transactions where you are trading assets, but we don't think that those markets have yet the maturity to be a long-term investors.
And how bullish are you on some of these other markets? You didn't really get into naming them by names, but where are the real bright spots and the real big-time growth prospects for you on the economic side?
Obviously, there is a lot of discussion on the China bubble, but that's what makes business very interesting. Is you have a China bubble in real estate in some cities, but if you look at through the different cities, you have other places which are very significant and where you can deploy capital quite smartly. You have a country which has been quite difficult for foreign investors, which is India, but the growth is very strong and the needs are tremendous. So if you find the way of accessing this market with the right partner, it's an economy you will like. Brazil is also a very interesting market. So those are the markets that will come. But you have a lot of other countries which are also attractive. But if you look at for markets where you have depth, those are the three markets I will mention.
Thank you. And Dr. Schmieding, looking strictly at economic growth, are there any big stars for you looking in the beyond the BRICS realm? I'm thinking of maybe Indonesia and that category of country.
First of all, one brief comment on the BRICS, if I may. I think BRICS is a misnomer. We should take the R out of the BRICS.
That is an argument that's been made and has quite a lot of weight.
Exactly. The point is that Brazil, India, China are countries that are doing well because they have opened themselves up either to the world or in India more to domestic investment by abolishing some regulations. So these are reform economies who are reaping the benefits of reform. Russia is in the category of resource economies, which is doing well and can do extremely well depending on the oil price, but where your future investment may always be at risk if for some reason the oil price falls significantly. So we have across much of the emerging markets both kind of economies, reform economies and resource economies. I would always try to draw a clear distinction between them. Indonesia seems to be a place more a reform economy, probably the same for Vietnam. Whereas in Latin America, we find a few places, Venezuela, which is clearly just a resource economy and not doing well for that. We find a non-reform economy at the southern tip of Latin America, Argentina. So we have to be very careful when we make generalized forecasts for emerging markets. The closer I look at them, the more sort of I see the differences between them, and I would not just go into emerging markets because it's a theme. I'm an economist, so that's the only advice I can really give is get a clear idea whether the countries have an economic policy set, whether they have had structural reforms that is conducive to private sector growth in the long run. If they have that, then you can ride out the cycle in these economies and you're likely to be rewarded. If they seem to be just riding the wave of high resource prices, then probably not the best bet in the medium term.
Thank you. Would you view that in a similar paradigm in terms of assessing where the most attractive markets are?
Yeah, I will concur to this approach, yes.
Well, I think at this point, I want to check and see if we have any questions yet from the audience. I have a few more things I might like to ask you, gentlemen, but we have two quite elucid and well-versed speakers here, so I thought you might like an opportunity to get some more detailed information out of them, which I'll present to you now. Now, don't be shy. It's in the dark. We can hardly see you anyway, so don't. Yes. And please may I ask, before you say your question, that you state your name and which organization you're with. Thanks.
Can you hear me?
Kind of. Might you speak up a bit?
Oh, sure. Hi, my name is Domas Dargis. I'm from Lithuania, a real estate developer investor. My question is very simple. Do you see a China property bubble existing? And if you do, what do you suggest we should do? Go to China, exit China, stay there and wait, see what happens? Thanks.
A China property bubble. Do you see this happening? Thank you for your question.
Perhaps I can say a few general words on that. First, I do not see a major China property bubble. It's possible that there are bubbles in individual cities, and I don't want to make forecasts on them. But there are two important things to remember about China in this context. First of all, it is an emerging market still in its early phases of development. Urbanization is not over in China. So, unlike in Japan or some Western markets, such as parts of the US, it's highly likely that at some stage, almost everything you build in China now will be physically needed, which is different from some of the developed markets where you can have, such as parts of Spain, where probably you're not going to need some of that real estate ever that had been built in recent years. And the second point about China. The economic consequences of property bubbles or the economic damage these bubbles do depends very much on how the authorities react. If they stop the resulting rot in the banking system early on, then the bursting of a property bubble typically has only a limited impact in terms of time and a limited impact in terms of economic damage. In China, it is highly likely that that country, with foreign exchange reserves of about 2.9 trillion US dollars, would step in almost immediately to stop a major real estate problem affecting the banking system and the wider economy. So that probably, even if a couple of regional bubbles were to burst in parts of China, the overall damage to the Chinese economy and to the overall market would remain limited in scope and limited in its duration. So basically on trend, I'd be in there.
Okay, I will make two comments, two answers. First of all, if you want to deploy capital in Asia, you have to accept volatility. If you look, even their very mature market, which had a quite long history, Hong Kong and Singapore in property markets, those markets have been always very volatile. So, if you go there, accept the volatility element. On China, I will not answer for all the asset classes because we, as a practitioner, we have decided to focus on residential. So I will answer to your question on residential. We have analyzed in depth more than 25 cities to deploy capital there. And we consider that there are some cities where you have currently another pricing element. But there are other cities where currently, if you look at the supply and demand, the need, those markets are still reasonably priced. As an actor, you need obviously to look at the classical elements of supply and demand, but you need also to take into account the urbanization element which is currently happening, what the government is trying to achieve. And when I mean the government, it's not only the central government, it's also the regional governments. So in terms of executing your investment strategy, those markets are hectic, but are in fact quite easy to analyze and to understand.
Thank you. Yes, here.
I'm Giacomo Catalano, president of Cata Commercial, a global property market advisor based in Rome. I would like to learn when the incredible Chinese prosperity will be reflected to Europe. For example, sooner or later there will be, we will be able to see a return of this incredible prosperity, and they will start to invest and diversify in Europe or in the US. And then I write down here that the capitalism has a natural capacity to regenerate. So I see prosperity in front of us, the ability of all of us to recreate the real estate restart. So I would like to see the light out of this tunnel. And I see another incredible sign that a couple of years ago, MIPIM was pretty static. Now I see a lot of more people enjoy meeting other people and enjoying other parties. So let's get together to more dynamism and prosperity. Let's create all together.
Practically, I will make two comments on your point. The first element is if you look at last year, the impact of Chinese visitors in Europe has been quite significant in some sectors. If you take the hotel industry, if you take the retail, I think one of the big retailer, big department store in France announced that 35% of their sales in the summer were done with Chinese purchasers, and with an average basket which was quite substantial. So this is happening. If you have in mind capital coming out of Asia to invest in Europe, it's also happening, and in particular in property, we have seen capital coming out of Korea. Korea is a quite tight market. Also, people need to diversify their allocation. Some Korean investors have started to do it in London, in Berlin. You have also Chinese institutions, sovereign funds, insurance companies, which are currently investing in our market. They have some regulations or some approvals to get. Also, they need to justify those investments to their government. But for example, if it's an investment where they can not only deliver performance but learn, gain experience that again they can import in their own countries, I'm sure we'll see them deploying capital in Europe and in the US. So that's what I will call the feedback from the Chinese wealth in our own economies.
We'll be able to share.
Maybe. Do you have any comment on that, Dr. Schmieding, about how much money should be coming out of there and where it's going, and if this gentleman can get some of it?
Well, you should have a good chance of getting some of it if you're in Rome. I fully agree with what you've just said. I think that over the years, not for any particular year, but over the next 10 years, the biggest global trend will be that Mrs. Lee goes shopping. China goes shopping. First of all, retail sales, which in China are rising about 15 to 18% year over year. That is an excellent market for us. Secondly, it means that China, which is saving a lot of money, even if in the future it saves a little less, has a lot of money to spend on whatever investment they want to do. That is not just resources in Africa, that will also be a lot of things in Europe. Of course, this will exacerbate trends which we anyway have. The Chinese don't know all of Europe equally well. They probably will focus on the prime locations. They will focus on the best brand names when it comes to consumer goods. So these distinctions between what is normal and what is world-class, be it in brand name, be it in location, will likely become even more significant now that we have these distant Chinese who don't know much about Europe, but who are starting to learn, coming to Europe and spending money, and most likely will spend on the things that they've either read in their newspapers or seen on their TV. So Rome, I think the Côte d'Azur, Paris, a few other places will likely have a huge increase in visitors, and the same will mean huge increases in sales of top brand goods and potentially services and probably real estate as well.
Thank you. Other questions? Yes, back there.
Good afternoon. My name is Farouk. I am from the Silverline Group, Bangalore, India. Can you give us an overview on what your views are on India, please, on the real estate market, both retail and residential or commercial? Thank you.
Yeah, I will be modest because it's a market we are investigating also. I don't want to be too to have views which are too articulate on this, but first of all, I mentioned the fact that the growth in India is as strong as in China, which is there. The second element is there is still massive needs in terms of residential, in terms of office and retail. The difficulty is to enter your market, and if you look at in China, some people have been successful. Some have failed, but some people have successful. In India, very few non-Indian investors have made money. So that's the question mark. To my opinion, the sector which will be the easiest to understand is residential, because it corresponds to an immediate need. It might be luxury, it might be middle class as well. It's very easy to understand. For offices, retail, I think the sector lacks still a little bit of maturity. When we look at the quality of assets, it's a question mark. When we look at how to manage assets, it's also a question mark. So I will be more reserved, and personally I will I would go really first for residential before looking at the other asset classes. It doesn't mean that those asset classes will not perform, but it means probably that at this stage of maturity, it's better for domestic players.
Thank you. Oh, yes. Sorry, one first here and then there, and then that'll probably wrap us up.
Good afternoon. My name is Kele Moyo from the Investment Property Data Bank. Just as you were discussing BRICS, there was a lot of talk, obviously, about Brazil, China, and India, but very little mention about South Africa. And I just want to get your thoughts on that, because as of the 25 or so countries that we measure around the world, in 2009, South Africa had pretty much the strongest performance, so in terms of all property returns. So I'd like to get your thoughts on that. Thank you.
Maybe a brief comment about the economic situation there and your outlook, and then how you view the real estate market.
I'm not a particular expert on South Africa, so you have to excuse my half ignorance. My general impression from South Africa is that it is not exactly in the BRICS category, the Brazil, India, China, partly because it to some extent started from a higher level, its recent development process, but that it is probably an economy which, not with 8% growth rates such as India and China, but with real growth rates of a good 3%, possibly 4%, but probably a good 3%, could get through for quite a while, helped a bit by resources and hopefully helped by a better education system. So I would see that as a promising market, but in the longer run, probably not quite as exciting as the Brazil, India, and China stories.
You will have to excuse my complete ignorance of the South African market. So, you know, I can't really give you any insight. What I will say, which is I think something very important in our business, is which is a difficulty when you are a global player. We don't want to do investments if we don't have a local team. So we have to be very selective. Even in Asia, you know, where we are very bullish on a lot of economies, we do things step by step because we need to build the local teams. So for the time being, South Africa has not been a radar screen, and I cannot comment.
That in itself is probably your answer. It's just not quite there on the radars yet. I think we can take one final question. We've just got about 5 minutes left. Yes, sir.
Thank you. My name is Vincent Wang. I'm a developer from London. I'd like to ask you for more clarification on your outlook for inflation or stagflation. The property market, of course, as you've said, is driven by the general economy, and the general economy is driven by money, and you've mentioned some of the issues, but including the amount of money being created, which traditionally has led to inflation, but in this case may not do. And I'd like to hear your further thoughts on the risks of inflation versus stagflation on the property market in Europe.
Thank you. That's a very interesting issue, inflation. First of all, to your very last point, a lot of money. Yes, central banks have injected a lot of money into the banking systems. However, not much of that money has spilled over into the economy at large. So far, this is not really inflationary. It has helped to stabilize and improve the financial system. Of course, now that the Western economies are recovering clearly and might recover even more strongly if there are not further obstacles in the way, now central banks have to unwind their special liquidity measures. They have to gradually raise interest rates. If they were not to do that, then we would probably have half a year to a year from now a stronger growth in private consumption in the Western world, including the US, than we would like to see. In response to that, higher wage growth than we would like to see, and in response to that, significantly higher rates of domestically generated inflation. But with a number of obstacles from fiscal tightening to higher oil prices thrown at us, and some of the central banks getting ready to raise rates in the foreseeable future, I don't think that these risks of high domestically generated inflation in the Western world will materialize. A very separate issue is the imported inflation that we are now getting through higher oil prices. We just have to live with that. That is a bit of a dampener on our near-term economic outlook. It shows up for a while in higher rates of inflation, but with unemployment still fairly high in most Western economies and consumer spending modest to very modest in most Western economies still, the risk that higher oil prices will in themselves trigger a domestic round of wage price spiral inflation looks not very big to me either. So on inflation, I'm somewhat relaxed. In the Western economies, we will likely not see a major homegrown problem.
And Mr. Vaquier, how much sleep do you lose at night worrying about inflation as an investor?
No, in fact, you know, I know that a lot of us dream about it because it's a way to bail out the past, but inflation will not come back for the reason which were very well explained, and that's the reason why in my few words I thought that people have to accept the reality and the market values. And I think all the countries where people are trying to hide or smooth the situation over time are making the situation more painful to manage, and in particular in the banking sector. So, you know, the people, again, who believe that inflation will just make their mistake disappear, I think are making a mistake. The only issue is if Saudi Arabia was a problem and oil prices were going through the roof and we had a recession, that could create stagflation. But, you know, in terms of percentage, I'm not an economist, but for the time being, it seems that it's a low-risk scenario at this stage.
Okay, thank you. I think we might wrap up there, and thank you very much to the two gentlemen here with me on the stage who were fantastic, I thought. Lots of interesting things for us to take away. And thank you for your attention and for your questions. I know there were lots of things on this afternoon that you could have been doing, even if there wasn't sun outside. Many other things you could have been doing now, and we appreciate you joining us. Thank you.